At the Fed. I think that's the message that the Fed is signaling to the markets. Don't fight the Fed. There's a podcast, Odd Lots by Bloomberg. It's a pretty good podcast, actually, talking about the markets. Neel Kashkari was on the podcast. I'm going to elaborate a little bit on Neel. But the message here is Neel is a Fed governor, I think Kansas, if I'm not sure, or Minneapolis, I'm sorry. The Minneapolis Fed governor. And he said it. He said, don't fight the Fed. We want the markets to be subdued until inflation is under control. And I guess this is how it's going to be. This is Not Even Wrong podcast. It's August 31st, 2022. This is Krim Delco. Since the last update, we're down about 3%. The market's down about 2.5%. For the year, we're down 32.4%. The market is down 16.8%. We're underperforming by 15.4%. So this podcast with Neel, I think the purpose of Neel going on a podcast like that is clear, to send a message to the markets. And the message is don't fight the Fed. I think it's a very simple message. And what I like about Neel is that he's a clear communicator. What I don't like about him is a politician too, but let's talk about this a little bit later. Here's what's going on in the markets right now. So we have, excuse me, we have inflation, and inflation is dangerous. But what's even more dangerous is inflation expectation. And the Fed, for right or wrong, is mainly concerned about the anchoring of expectations. In other words, if you expect the inflation to be consistently high, you're going to change your behavior. If you just have a price hike once, let's say your rent went up once for some reason, or gasoline prices went up, or, we had a fire in California and electricity is high for a month. Those are the kinds of things that we don't like, but they're not that concerning because expectations, long-term expectations and long-term planning, in other words, things like how am I going to deploy my capital and how am I going to deploy my labor, those are the kinds of things that the Fed cares about more than the actual inflation numbers. So because the Fed is concerned that the expectation anchoring of inflation could be on the high side, that they are taking action and they want to suffocate the economy to the extent where people stop expecting higher inflation in the future. And that means they want the markets, because that's one of the mechanisms that the Fed works with. They manipulate interest rates. Actually, they do a lot more than manipulating interest rates. They signal to the market. And this is the key. They signal to the market. And Neel said that in the podcast. The good thing about Neel is he's a very smart person and he's very knowledgeable about markets because he's been a Goldman guy himself under Hank Paulson. A little history about him a bit later. But the point here is he understands markets really well. Maybe he wasn't a trader per se, but he definitely understands markets. So what he, excuse me, what he says in this particular podcast is that, look, we at the Fed, we have a job to signal to the market that we're not going to let inflation go high. And we're using the markets as the main mechanism to achieve that. And that's where the phrase "don't fight the Fed" comes from. He said, I didn't like the positive market reaction after the FOMC meeting, last a week ago. And then he said, I liked the market reaction after Fed Chair Powell's speech at Jackson Hole. Now, after the FOMC meeting, the market was up about 3-4%. And since the Powell speech, the market's down close to 10%. These are massive numbers. That's why they warrant the conversation. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. We are not a macro hedge fund here at Orange Capital Partners. So we don't do big macro investing. But we have to be conscious of the macro situation in order to explain to ourselves and our customers what's going on. We're down 32% for the year. That's a number that needs explanation. Can't just say I'm down. Sorry, it happens. Why we're down? Well, because we were fighting the Fed. How were we fighting the Fed? Well, we invest in innovation, we invest in disruption, we invest in fundamentally new concepts and engineering practices. This is our game. This is what we do. Excuse me, I'm walking up a hill and it's dry here in Los Altos Hills, my new home. So I am a bit constrained with talking, walking, and breathing at the same time. But nevertheless, the nature of this podcast is that I have to come out with my ideas when they're ready. And right now I'm just walking up the hill. So that's when I'm going to do this. What I'm trying to say here is that we were fighting the Fed, unconsciously, obviously, because nobody wants to fight the Fed. But we were saying fundamentally new concepts and engineering practices, they will create a massive amount of value. In particular, electrification of transportation, the solving of self-driving, and then the CRISPR revolution and the introduction of engineering practices into biology. Those are massive themes that will eventually lead to massive wealth creation. And we still are very convinced that that's going to happen. And if I had to take a guess where I'm going to be 10 years from now wealth-wise, I'm going to have a lot more wealth. But in the meantime, I'm fighting the Fed because the Fed has other ideas. And the Fed has the power to drive short-term market reactions through signaling. That's what Neel Kashkari said in the Odd Lots podcast. So let's take him by the word. That's what they can do. They know what they can do, which is one of the powers of the Fed, knowing what they can do. They can signal to the market stuff, and they can actually provoke a reaction. For example, they can signal that they're going to be hawkish, which just means we're going to keep putting our finger on the economy. We're going to keep putting on the brakes by raising rates or signaling to raise rates. In fact, the Fed is a little bit unhappy about the yield curve right now because the yield curve is flat. And I think what the Fed would like to see is a little bit of a steeper yield curve because that would fit their narrative a little better. And the reason they would like to see that is a little bit of a steeper yield curve would A, not signal a recession, and B, signal that inflation expectations are still too high, particularly in the long run, and therefore the short-term actions that the Fed is taking right now are warranted. But Neel is saying, look, don't fight us. Eventually we're going to win. Part of the flattening of the yield curve has also driven stock prices to recovery since the absolute lows in May and June. And that to Neel was also unwelcome. Why? Because just look at, forget the financial markets. Take a normal person. Let's say you're a software engineer at Facebook and you're looking for housing in Silicon Valley. Well, you're going to have an issue. It's very expensive. Now, if the stock market tanks and the Facebook stock goes down 50% and stays there and maybe even goes lower, then maybe Facebook will actually fire people and then the housing market will relax and therefore prices in Silicon Valley will be less aggressive. So this is one of the transmission mechanisms by which the Fed can influence the real world. This is on real world. So now for us in the financial markets, the repercussions are very different. We're not going to see our prices collapse or come down in a couple of months after Facebook announced firings and things like that. It's going to be a lot faster. In fact, it's going to be instantaneous. I mean, this is if there's economists out there or financial markets researchers, and they are doing models in how the signaling of the Fed actually affects financial markets, I am sure they are using things like instantaneous measures, like things like derivatives in a very, very short time scale, literally milliseconds after Powell says something or Neel Kashkari or whoever makes those statements. So the transmission mechanism is instantaneous and it's very volatile and it's very fast. Now, why is it volatile? Let's talk a little bit about volatility. Okay, somebody else once said volatility is just simply price mechanism, right? And if you take financial markets at their core and you actually take the efficient market hypothesis seriously and you say, look, financial markets are always efficient by taking all the information in. The problem is they're not very good at actually valuing things and judging things. That's a little bit more difficult. And therefore, we have volatility, which just is another word for price finding. Okay, price finding is like a person that doesn't have a map and goes from A to B, and the harder the terrain, the more unpredictable the terrain. There's waterfalls and then storms and bears and wolves and snakes. So you're gonna have to go around. You're gonna have to, have a pretty windy road towards your goal. And this is what volatile financial markets actually are. Sometimes they're not very volatile. When financial markets are not very volatile, that means that they're either pretty sure about where things are going, or they have the illusion of being pretty sure, which sometimes, and this was the pre-2008 period, that was the case. People thought everything is fine, and then, well, guess what? Things weren't fine. So let's get back to our conversation. Now let's talk a little bit about Neel Kashkari. Neel Kashkari grew up financially and academically and professionally within the Goldman machine. When I say machine, I mean in a good way. He was educated properly. I've never worked at Goldman. I've worked at other banks, Morgan Stanley, Merrill Lynch, Société Générale. So I have a sense for what it means to be properly educated within the context of Wall Street. You have a training program, but more importantly, you're exposed to people that talk a certain language, think a certain way, and sometimes even teach you stuff. And that's what Neel had the pleasure to do. And he then was picked by Hank Paulson to supervise the TARP program, which was the rescue of the banks after the 2008 financial crisis. He then went on and became a Fed governor at Minneapolis. I think that's where he's from. So what is his role in this whole situation? I think the Fed, either intentionally or unintentionally, is using him as a, I would say, as a sort of market signaling guy. He's the guy that signals to the markets what's coming, because he's the market guy. He's a lot of Fed, even Jerome Powell was a banker, but he is more of a trader. Neel Kashkari, I mean, he's the trader guy. He's the guy who actually knows how these signals transmit into pricing. And he's also the guy who knows what kind of signals to use to affect what kind of pricing. This is the way I see it now. Again, this is a conjecture on my side. I have no inside information or anything like that. And also, please don't take this as trading advice, by no means. Do your own work. This is just my conjecture. And why is this only my conjecture? Well, because I just don't know. I don't know Neel personally, and I've never been on the Fed governor chair or anything like that, or close to it. But this is how I imagine things go. No, they say we want to achieve certain effects in the market. We think the markets are a little bit too exuberant right now. We want to bring them down. And then Neel raises his hand and says, well, to bring them down, I think we can just say that rates will stay higher for longer. And we're going to signal that. And then guess what? Markets down 10%. Markets down 10% means, again, to my example of Facebook, likelihood of Facebook not hiring somebody or even firing people goes up. Rents come down in Silicon Valley. The transmission mechanism goes through. There's less construction. There's less investment. There's less demand, and so on and so forth. Now, there's a caveat here, of course, which is what Hugh Henry always says, is that tight money creates inflation. He's trying to be sneaky smart ass here. Sorry for my French. But what he's really saying, which is actually not so stupid or not so incongruous with economic theory, is just simply saying if you tighten money, then you curb investment, and if you curb investment, then prices go up because there's not enough supply. What Neel's saying is, no, that's not such a big problem because demand is always faster than supply. In other words, if we can curb demand and demand comes down and prices stabilize, then supply will come back because supply is driven by prices and cost. And that's true. And he said something else, which is very important, which I like. And I'm going to finish this episode with our conclusion, because this is not supposed to be economic theory. This is actually supposed to be, a little bit of a help for people to navigate financial markets, or at least for people to get a sense for how it feels like to run a hedge fund. That's the purpose of this podcast. and how we feel about all this. So what Neel also said is that he hopes, or the function that actually matters in the end, that will bring down inflation, that is how fast the cost curves, the the cost side of things, the producers, the companies, how fast they adjust to the new environment. So if lower rates, you have you have higher rates, you have higher interest rates, you have less demand, you have a curb of demand, you have a curb of hiring workers, you have everything gets curbed, everything gets put on hold, and then what happens, this is now Austrian economics, but it really is true. What happens now is you have the better producers, so the Teslas of this world, they will react faster because they have stronger demand and more pricing power, and they will gain some market share, and they will hire the best people, and they will crowd out weaker competitors. And then when demand comes back, when the Fed kind of stops with all this rate rising exercise, well, they will be the stronger ones coming out. The economy will be better, more efficient, and we'll have a healthier economy. That's the hope, that's the idea, that's the way these things work, at least in theory. In practice, they never work like that, not because the Fed people are bad or anything like that. I think it's just simply because there's too many complex variables and the Fed cannot foresee everything, which is kind of the reason why this whole central planning exercise in the first place is not a good idea. I think Neel said something else which is very concerning to me. He said that, well, if I had a rule-based monetary policy, if I was always a dove or always hawkish or something like that, that would be bad because then I cannot react. Well, that implies that his reaction actually adds value. And of course, he himself thinks it does, but I would say that that is an open question. And I would also say that, actually, I would even dare to say that no, because the speed of error correction that he has, or the Fed has, is way, way too slow to correct the errors. So that means that if they create one error, then they just simply will correct by creating another error, and then correct again, and then we compound the errors. This is the one thing where I disagree with Neel, and I would like to have a conversation. And maybe if he's listening to this, Neel, contact me in the comments. I'm happy to have that conversation. I mean, how do you guys think at the Fed you can actually correct errors timely, and why are you so anti-Popperian? Is it just the nature of your job, or do you have something else to say? Anti-Popperian means, Karl Popper would have said in this context, well, you're solving a problem, but you should have the markets, or you should have a much faster decentralized mechanism decide how things go, and not the central mechanism of the Fed. And if you agree with that, then how could we reform the Fed so it becomes a little bit more market-driven and data-driven and less centrally planned? But that's a whole different podcast. So to summarize, here, where we are today, right now, is the following: the Fed has power through signaling to the markets, and the Fed right now is signaling that they don't want the markets to go up because inflation is still not under control, and therefore the markets need to be held in check. And the phrase "don't fight the markets," don't fight the Fed, is applicable here as much as it always has been. In other words, don't go along the market right now because the Fed just doesn't want the markets to go up. Now, for us as hedge fund managers, this means that we can, of course, get out of the market. But the problem with all of this, and this is also the problem that Neel has, is, well, you don't really know what the level is. Why should they get out? Maybe they already anticipated all of this. So those are the kinds of questions that he is also leaving open and that need to be answered. But having said all of that, I think we at Orange Capital Partners, now, how do we feel about all this? We don't want to fight the Fed, but we also don't want to give up on our thesis that long-term, fundamentally new concepts and engineering practices with large impact will generate wealth, and that our investments in those assets will yield the kind of wealth that we expect to generate. Thank you.